Hello, VITA volunteers. In this lesson, we will be taking a tour of personal income tax returns for the state of Oregon. We will walk through the forms, look at some important differences between full year, part year, and non-resident returns, and identify some common additions, subtractions, and credits. And as I just mentioned, for Oregon returns, our taxpayers will be sorted into one of three categories based on their residency. Each type of taxpayer will use a different form to file their taxes. Full year residents will file Form OR-40. You might recognize the 40 from the federal 1040. Part year residents will file Form OR-40P, P for part year, and non-residents will file Form OR-40N, N for non-resident. So how do we know which form is appropriate for our taxpayer? Oregon gives us some definitions in publication OR-17. Again, you might notice that this follows a nomenclature for the Federal Publication 17 Tax Guide. This information can also be found in the Oregon 40 booklet, which has a line-by-line instructions for the form. In short, full year residents will have lived in Oregon the entire year. However, persons who do not reside in Oregon may still be considered full year residents if all of the following are true. They think of Oregon as their permanent home. Oregon is the center of the taxpayer's financial, social, and family life. And the taxpayer, during the time that they lived outside of Oregon, intended or intends to return. A part year resident will have moved into or out of Oregon during the tax year. And this can include taxpayers who temporarily moved out of or into Oregon. The difference between this situation and the full year resident situation would come down to intent. For instance, in this case, a taxpayer may have moved to a different state intending to make that new state their home, but unforeseen circumstances brought them back. This is different from the full year taxpayer who always intends to return and maintains their home in the state while they are absent. Lastly, a non-resident is someone whose permanent home was outside Oregon all year. And this would commonly be our taxpayers who live outside of Oregon but work in the state. Full year residents, non-residents, and part year residents are taxed differently. Full year residents are taxed on their income from all sources. This can be compared to the concept that U.S. citizens are taxed federally for all worldwide income. Non-residents, on the other hand, are taxed only on the income from an Oregon source. And then part year residents will be taxed based on the allocation of time that they were considered Oregon residents versus non-residents. One of the first things we will need to determine is whether our taxpayer is required to file a return for the state of Oregon. You will notice here that Oregon has much lower filing thresholds than the federal requirements. Thresholds are still based on the filing status, and the full year resident table is also dependent on the number of checked boxes on line 17 of the return. And these are exemptions, which we'll talk more about later. You might also notice that the filing threshold for part year and non-residents is even lower than for full year residents. Now that we've determined whether our taxpayer is required to file, let's get an overview of the form. I'm going to start with the full year resident form so that we can get accustomed to its structure. After that, we can look at some of the notable differences for part year and non-residents. Page 1 starts with the basic information and filing status, and this information will automatically flow from the federal entries in the TaxSlayer software once the state return is added. At the top of the return, there are also some checkboxes that indicate circumstances that would require special handling, and you would need to input these into the return. Instances where a checkbox could be checked are For an amended return, Oregon uses the same form for original and amended returns. So in the case we are filing an amended return, we would indicate that using this checkbox. There is also a checkbox for as if returns, and this is not to indicate whether or not the taxpayer is a Valley Girl. This checkbox would be used for registered domestic partners who were filing as if they were married, or for taxpayers who were filing as if married filing separate because spouses had different residencies for Oregon. There's a checkbox for a short tax year. This would be in the case of a bankruptcy. And then another checkbox if an extension were already filed for this return, and then we would indicate it. The box for Oregon 24, which is a form, has to do with like-kind exchanges, and these would be out of scope for us. The box for Oregon 243 would be for claiming a refund for a deceased person, and this is something that we could possibly see. There's also a box if Federal Form 8379 is being filed for an injured spouse. And if you remember, that is when one spouse owes a debt that will result in a garnishment of the refund, and the other spouse can request that their portion of the refund is not garnished. There is also a box if Federal Form 8886 was filed for reportable transactions, which has to do with tax shelters, and this is out of scope for VITA. And the final box is for presidentially declared disaster relief. Page 2 begins with exemption credits. And we discussed in our federal tax trainings that taxpayers are entitled to an exemption for themselves and their spouse if they cannot be claimed by somebody else. They are also entitled to exemptions for each of their dependents. Before 2018, these exemptions would result in a deduction from taxable income. However, that amount was reduced to $0 until 2025. Oregon has a similar concept for exemptions, where taxpayers and dependents each get an exemption, which is indicated by checking the box for a regular exemption. Each of these exemptions could result in a credit further down the return of $219. However, the ability to claim these credits is limited by income. Extra credits can be claimed if the taxpayer or spouse is considered severely disabled, which includes the loss of one or both hands or feet, blindness, or some other permanent condition that limits the taxpayer's ability to earn a living, maintain a household, or transport themselves. It is important that our taxpayers know that this must be substantiated by a doctor's note. And then if our taxpayers can be claimed by somebody else, they will not be able to claim the exemption credit at all. The dependent section, which flows from the federal entries and tax layer, also has a checkbox for an additional credit if the child had a qualifying disability, was under the age of 21, and was eligible for special education or early intervention. This might include disabilities such as autism, another specific learning disability, or a physical disability, among many others. The instructions have a list that can help determine if the disability qualifies for the additional exemption. On page 3, we begin with the taxable income section of the return. For Oregon full-year residents, this begins with the federal adjusted gross income. Here again, TaxSlayer automatically pulls this in from the federal inputs. The next line, line 8, is for additions that flow from Schedule OR-ASC, and that's ASC for additions, subtractions, and credits. Some sources of income that are not taxable for federal income tax are taxable to Oregon, but more on that in the coming slides. Then we move on to the subtractions section of the return. Some income that is taxable federally is not taxed by Oregon. So line 10 begins this section by subtracting the amount of federal tax liability up to $72.50, depending on AGI. Line 11 subtracts federally taxable Social Security benefits, and this results in Social Security benefits being fully tax-free to Oregon. Line 12 is for any amount of Oregon tax refund that was included in federal income, and this might be applicable in cases where taxpayers itemized deductions on their federal return in the previous year. Line 13 is for subtractions that flow from that Schedule OR-ASC again. And after that, we move on to deductions. Oregon has a standard deduction. However, as you can see highlighted here on the form, the Oregon standard deduction is much lower than the federal standard deduction. This means that some of our taxpayers may receive a better benefit by itemizing for Oregon, even if they could not get above the federal standard deduction amount. In this instance, the taxpayer would take the standard deduction on their federal income tax return, but itemize on their Oregon return. In TaxSlayer, we would enter the itemized deductions in the federal inputs. The software will choose the federal standard deduction where that amount is higher, and the itemized inputs will flow on to the Oregon return. On page 4 is the section for tax. Just like we learned for federal income tax, this generally flows from tax tables. There are other methods of calculating tax that could result in a lower tax amount. However, these methods would only be applicable for returns that are out of scope for the VITA program. After tax, we move into the standard and carry forward credits section. These are non-refundable credits, which, just like we learned for federal income tax, can reduce the tax down to 0, but not beyond. With standard credits, any amount of calculated credit that was more than the amount of tax would be lost. With carry forward credits, the amount of calculated credit that could not be used in the current year could be carried forward and used in future years. This is the section where that exemption credit that we talked about earlier shows up. Line 24, just below that, is the political contribution credit. And if you remember, political contributions are not deductible for federal purposes. In Oregon, however, taxpayers can get a credit for political contributions up to $50 or $100 for married filing joint taxpayers. Line 25 is for standard credits that flow from that Oregon ASC, and line 28 is for carry forward credits that also flow from that same schedule. On page 5, we have the payments and refundable credits section. By now, you're probably noticing that the flow of the Oregon return is in many ways similar to the flow of the 1040. Line 32 is for state income tax withholdings. Line 33 is any amount applied from a prior year refund. Just as we learned in our federal lessons, taxpayers may choose to apply their refund toward the coming year's tax liability. Line 34 is for estimated payments. Line 35 is for payments made by a pass-through entity that would flow onto the tax return, and this would be out of scope, so don't worry too much about it. Line 36 is for the Oregon Earned Income Credit. This is a percentage of the federal EIC, and it's based on the age of the youngest qualifying child. Notably, though, that taxpayers who are not eligible to claim federal EIC because they were filing with an ITIN, they may be able to claim an Oregon EIC. Then we come to the section for taxes, refunds, and penalties for underpayment. But that's not all, folks, because we have page 6, which picks up where page 5 left off with taxes, refunds, and penalties. Notable in this section, Oregon taxpayers may choose to donate their refunds directly to a selection of charitable organizations, which are listed on Schedule OR-Donate. Taxpayers may also choose to donate to a political party. Or, similar to how federal taxpayers have the option to purchase federal savings bonds, Oregon taxpayers have the option to put their refund into the state-run 529 College Savings Plan. They may use Schedule OR-529 to deposit into an existing account or create a new account to deposit into. And last but most common, taxpayers can enter their direct deposit information or receive a check. Page 7 is for taxpayer signatures and includes instructions for how to pay as well as where to send the return if they are filing a paper return. I bet you thought we were done. Well, not to disappoint, we have page 8. And this is where we would put any notes regarding changes if this were an amended return. Whew! Now that we have made it through the return itself, as promised, we will take a look at Schedule OR-ASC. Again, that's ASC for additions, subtractions, and credits. You'll note the sections here on the form. You'll also note that instead of line items printed directly on the form, there is a column for a 3-digit code. Each addition, credit, or subtraction has its own code that would be entered on this form along with the amount. You can find the codes in Publication Oregon Codes, but let's look at some of the more commonly seen codes for our clients. Let's start with additions. This is income that was not federally taxable, but will be taxable to Oregon. First is the federal income tax refund, Code 109. Because we get to deduct the federal income tax liability based on the amount filed with the federal return, if there was a later adjustment that resulted in a lower federal tax liability and the taxpayer received a refund, they would need to claim that as an addition to Oregon in the next year. Otherwise, the taxpayer would receive a tax benefit for an amount they ultimately did not pay. Code 117 is for non-qualified withdrawals from a 529 college savings plan. This might be compared to how withdrawals from HSAs or health savings accounts become federally taxable. The money was not previously taxed. Now it's being pulled out for non-qualified uses. The amount becomes taxable. Code 134 is for gambling losses claimed as an itemized deduction. And this occurs where the losses claimed for itemized deductions exceeds the taxable Oregon gambling winnings. We'll see why this might happen on the next slide. Code 158 is for interest and dividends on government bonds from other states. If you remember, municipal bond interest is not federally taxable. Not so for Oregon, so we must add it back to income. So let's talk about subtractions. Indigenous persons whose income was earned in, quote, Indian country do not owe Oregon tax on that income. Income earned outside of Indian country will be taxable, though. Federal pension income is not taxable, nor are amounts paid as foreign income tax. While interest and dividends on U.S. saving bonds was included in the federal taxable income, it can be subtracted out of Oregon taxable income. And then we have Oregon lottery winnings. Taxpayers may exclude from Oregon income up to $600 of winnings on a single ticket or play. This is why taxpayers who deducted losses up to their federally taxable winnings might need to add back some of those losses so that they are only deducting up to their Oregon taxable winnings on their Oregon return. Important for this subtraction is that if a taxpayer won over $600 on a ticket or play, they can't report the net amount of winnings. The winning amount must have been $600 or less. Tier 2 railroad retirement benefits are not taxable to Oregon and can be subtracted out. Also, Oregon allows a subtraction for scholarship awards that were used for housing expenses, unlike the federal rules that taxes scholarships used for living expenses. And then we come to the special Oregon medical deduction. This is for taxpayers of age 66 and over who have medical expenses that could qualify as an itemized deduction, but were not itemized or deducted somewhere else on the Oregon return. For credits, we have the retirement income credit, which is a standard credit. This is for taxpayers who are 62 or over, whose household income, including Social Security or Tier 1 railroad benefits, is less than $22,500 or $45,000 if married filing jointly. Additionally, that Social Security or Tier 1 benefit must be less than $7,500 or $15,000 if married filing jointly. The Working Family Household and Dependent Care Credit is a refundable credit that is conceptually similar to the Federal Child and Dependent Care Credit. Contributions to an Oregon 529 college savings plan are eligible for a refundable credit. And as mentioned before, ITIN filers can receive Oregon EIC that would not flow from the federal return because they would not qualify for the federal credit. Now that we understand the flow of a full year resident return, let's look at some of the notable differences for part year residents and non-residents. For illustration, we will be looking at the part year resident return as it shares many features with the non-resident return. On page 1, you will note a couple of extra checkboxes in the top section. One is an employment exception that allows certain hydroelectric dam workers, interstate railroad workers, or truckers to exclude their income from taxation in Oregon. You can look up the Amtrak Act in publication OR-17 for more information. The other checkbox is for military personnel who are stationed in Oregon but not domiciled in Oregon. Then you will notice on the Oregon 40P, there are residency dates, which are used to calculate the allocation of income taxable to Oregon based on residency. The Oregon 40N does not have this, as residents will have lived outside of Oregon for the entire year and will therefore be taxed as non-residents for the entire year. Skipping ahead past the dependent section, we come to page 3 for the income section. You will note here that instead of starting with federal AGI like we did for full year residents, we start with wages as reported on line 1Z of the 1040. Then each line item of income is reported separately. Further, there are two columns, a federal column and an Oregon column. In this way, each line item of income can be treated separately as taxable for both federal and Oregon tax purposes, or taxable for federal purposes, but excluded from Oregon taxable income. The two-column layout continues through income, adjustments, which was the section we did not see on a full year resident return since it began with the adjusted gross income, additions and subtractions until we reach line 35, which is the percentage of income taxable to Oregon compared to the income taxable for federal purposes. This is a pivotal line in part year and non-resident returns because most of the tax benefits, deductions and credits, etc., that occur below this line will be calculated and then multiplied by the percentage. So unless the part year or non-resident had 100% of their income come from Oregon sources, they will receive less than 100% of whatever tax benefits they are otherwise entitled to. On page 7, we have another section we didn't see on the full year resident return, modifications. This section includes items such as additions and subtractions that are adjusted for part year and non-residents. Additions will be reported as negative modifications. And non-residents and part year residents have their own version of the Oregon ASC, Oregon ASC-NP. The whole schedule is not depicted here, just the two new sections that are not shared with the full year return, adjustments and modifications. Common adjustments are for health savings accounts, penalties on early withdrawals, which is only available for part year residents, and other adjustments from the 1040 Schedule 1, lines 23, which is for Archer MSA deductions, and 25, which includes a lot of other deductions, notably for us, jury duty pay. Common modifications are the federal income tax refund, which we saw was an addition for full year residents and should be entered as a negative modification. Foreign income tax was seen as a subtraction, and gambling losses, which was otherwise an addition and should be entered as a negative modification.